Guys, 3 undervalued stocks that check all of our boxes and are 8 pillar thrillers. Let's go check them out right now. Guys, stock number 1, Dick's Sporting Goods. Now, guys, all 3 of these stocks have all 8 check marks for our 8 pillars. I'll get into that shortly, especially if you're new to the channel, to see what the 8 pillars means. But Dick's Sporting Goods, this thing has been flying high. It got as low as $13 per share at the COVID low. Why? It's retail. People thought the world was shutting down forever. Fear. Every past fall looks like an opportunity. Every future one looks like a risk. This thing is up how much? 15, 18 times since the COVID low. $18.5 billion market cap. And an interesting thing here, their enterprise value is 23.8. That $5 billion difference is essentially the net debt. That's not a lot for a company with a lot of retail locations, right? So that's pretty interesting. They have a 1.8% dividend that eats up $340 million of their free cash flow. And the thing I love, free cash flow over the last 5 years, $933 million. Net income, $931. Very much in line. So that's pretty good. And a very solid return on invested capital, especially for retail. This shows you this company does a good job managing the cash within the business and getting a good return on that cash. Now, when it comes to retail, especially in this environment, we got to know, are they opening stores or closing stores? And on the stores that already exist, what are their same store or comparable store sale growth year over year? Mo, do you have that info for us?
So they have 724 total stores.
Okay.
Same store sales, 2.4%.
Okay, so that means stores that have been open for longer than a year saw 2.4% growth in their revenue. That's pretty solid considering how much people can buy online. Mm-hmm. And Dick's does a great job with online sales, don't they, Mo?
Oh yeah, not only online sales, but like online sales where you can pick up curbside. And
Easy.
They were on the cutting edge of that curbside pickup during COVID.
Were they?
Yeah.
Go ahead, Mo.
So 1 new store, 5 closed stores, gives you that ending stores of 724.
And correct me if I'm wrong, don't they have some new model of a store they're doing right now?
Specialty concept stores?
Yes. What do they have, like 100 of them?
125.
Okay. And those are doing quite well.
Yeah.
So Dick's is sitting there saying, listen, retail's changing. We got to change along with it. I like that. Now, let's go look at the 8 pillars. And remember, guys, if you're new to the channel, this 8 pillars is not there's all 8 check marks, go buy it. The 8 pillars are there to tell a story. So what's the story that's being told here on Dick's? 2 valuation metrics, 20 times their 5-year net income and free cash flow. Now, revenue growth, $5 billion growth in the last 5 years. And that led to $900 million in net income extra and $965. That's pretty solid growth right there, because if you look at that, that's almost 20%. And yet their bottom line margin is only 7 or 8%.
Especially for brick and mortar.
Especially for brick. Absolutely. So this is really good stuff. Good return on invested capital. Not buying back a lot of shares, which I'm okay with, even though the price of free cash flow is 16. But guys, isn't that incredible? They were selling for $13 a share. What was their price to free cash flow be today if it was still selling for $13 a share? Now, this is a company that I'm hoping that if the price starts to fall and fall precipitously and good, buy back those shares, guys. Yeah. Stop the stupid dividend. Mm-hmm. Why are you paying a dividend, guys? Why are you paying a dividend? Now, if you have our software, you can customize your 8 pillars up to 12 different pillars. So remember that. Now let's see. I want to look at those income statements here to see this revenue growth. Look at this revenue growth, Mo. Now it's slowed down, but it's still growing. That's the impressive part. 6.8 billion, 7.3, 7.9, 8.6, 8.4. Guys, all along this way, online sales were growing and growing and growing for the world. And they kept growing their revenue. They were opening more stores too, but I bet you if you go back and look at their same store sales growth year over year, it was probably pretty solid.
Do you worry about the big jump that they had from 21 to 22? But now they've stabilized at that 2022 jump.
Yeah, 3 years in a row of stable and still growing.
Yeah,
it's pretty solid. I'm not going to be as worried about that here. Net income has jumped since before COVID. Absolutely skyrocketed. That's the question. Is that going to be a permanent thing? So let's go look at analyst estimates. Wow, look at analyst estimates here, Mo. Not big growth, but still growth in EPS. And guys, if they're able to buy back, we're talking about $12.55, $13.40, $14.50, $15.50, $15.90, $17. Mid to high single digits. Nothing to write home about, but pretty solid for retail. And revenue growth, A little fluctuating, but 5.5%, 2%, 4, 5, 1.7, 3.5. So about inflation, right?
Yeah, nothing crazy.
Yeah, nothing crazy to write home about, okay? So what is this company worth to us? Dick's Sporting Goods. The last time I did it was May 29th. Now, I did a 10-year analysis. And remember, guys, friendly reminder, does not include the balance sheet here, okay? And look at this increasing. 10 years is 4.3% ROIC. 5 years is 17%. Revenue growth, I did 2, 3, and 5%, significantly lower than its 5 and 10-year numbers. Profit margin, I did 6, 7.5, and 9. I'm wondering if I'm being too strict here, even though the 6% was, because their profit margin has increased for sure in the last 10 years. Mm-hmm. But let's say they go back to more normal. I'm fine with this. I did the same thing for free cash flow. PE. Okay, now, Mo,
I actually like those numbers.
I do 13, 15, 17, but then I look at my desired return and I go 11, 13, 15. I want to actually put the 9% across the board here, and they are a better retailer. I think I'm going to keep that. I still don't think I'm like, let's do 13, 16, 19. Because at the end of the day, Mo, that high return on invested capital shows they're doing something good with the money.
True.
They're managing their money well. So I'm going to hit 9% return. Now remember, the 9% return is about what the market does, 9 or 10%. So this isn't any margin of safety here. This is all purely intrinsic value, but you need to put margin of safety. If not, just go buy a long-term ETF and write it out for 9 or 10%. But the future's unknown and we're humans. We're going to make mistakes. You got to have margin of safety in here. I hit the analyze button. I have a low price of 130, high price of 300, middle price of 190. It's on my watch list at 130, but I think I'm going to lower that to 175. But I'm not going to buy it at 175. This is purely my notification that the software will send to me so that I can start selling puts at lower prices. I can be paid to wait for the stock price to fall. Stock number 2, NVR. Mo, look at the stock price. $7,700 a share. Who is NVR? Well, in our area, NVR is Ryan Holmes. Okay. Now, this is well known as being the multi-bagger of multi-baggers. Mm-hmm. Look at this thing. This thing was at $45 a share back in 2000. $45 per share. So when was the last? It was at $75 a share in August of 2000. Okay. So it's up 100 times since August of 2000. Now, let's go look at the income statement. 2000, they did $2.3 billion in revenue. Today, they did 9.7. So what is that? 4x. The stock is up 100 times.
How is that possible?
Interesting you should ask that, Mo. Well, let's go look at the profit here. By the way, Mo is being facetious. He knows exactly why. The profit was 160, and now it's 1.6. 10x.
Still.
So how is the stock up 100? Well, you might be like, well, maybe the PE is like $1 billion or something really, really high. What's the current PE? 15. So how did they do it?
How did they do it?
Guys, this is one of the greatest examples of cannibalizing your stock, buying your stock back at cheap prices. Look how many shares outstanding they had in 2000. They had 9 million shares outstanding. Today, they have 3 million shares outstanding. Now, the PE back then was probably 8 or 9 already. So you had PE expansion along with growth in the business, along with buying back 70% of their shares. That is how you get to a 100 bagger. You don't need the business to go up 100 times to get a 100 bagger. That's the big key here. In 25 years, it went up 100 times, not because the business went up 100 times.
And this goes back to Dick's Sporting Goods. Why are you paying that dividend?
Correct.
Use your money more efficiently.
Correct.
For your shareholders.
Correct. Now, if Dick's has to wait for the stock to fall a little bit, many times during this period, NVR was selling for 9, 10, 11 times earnings. So buying back those shares were essential. But you know what else you're going to find with NVR? They haven't paid a dividend since 2000. I don't even know the last time they paid a dividend.
Yeah.
Guys, dividends are not all they're cracked up to be, especially when companies are selling for cheap prices. That is especially key for you to understand. And I also want you to understand that 7,700 means nothing.
No,
doesn't matter. It's still a $26 billion business. Remember, Dick's was an $18.5 billion business and the stock was $220. All you should care about is what's the market cap and how does that translate into the stock price? What's price relative to value? So another 8-pillar thriller. 20 times PE, 21 times price to free cash flow, bought back 13% of its shares in the last 5 years, revenue growth of $2.4 billion translated to some pretty solid cash flow and net income growth, and this high return on invested capital and low debt. Guys, this is a company that manages its capital so incredibly well. So let's go see what analysts are saying. There's not many analysts following this company. Basically the same earnings per share for the next 3 years. Nothing to write home about. Again, revenue, basically the same. Blah, 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 blah. So let's go to Stock Analyzer tool. Have we ever done NVR?
I never have.
One time, March 30th of 2023.
All right, let's see.
I did 3, 5, and 7% revenue growth. Profit margin, 11, 12, and 13, even though they've been higher than that. Same with free cash flow. PE, look how low a PE I put here. 8, 11, and 14. And again, back then I was still I'm doing now more of the market returns, 9%. And I think this PE is very low. I'm actually going to change it to 12, 15, and 18. And I think that's me being still low on it. Hit the analyze button. Look at this. 4,800, 10,500, 7,000 in the middle. Yeah, I'm adding this to my watch list, but I want a really deep discount on it. So I'm going to take it. I want to start looking at it at $6,000 a share. Notify me. Guys, you have to understand this. This is what's so key about understanding and investing. Now, if you've watched our channel many times, you've noticed that we have a waiting list for everything money. And the reason for that is because the software, as we did today, includes everything we have to offer for stocks, retirement, and real estate. But behind the scene, we are making a lot of changes. So in a short period of time, that offer is going away. It's not going to be possible to get everything. We've been doing a lot of feedback from the customers and our users. And the main thing is people want focus. They don't want to have the Cheesecake Factory of options when they're using the software. But if you recall, if you were one of the OGs back watching us when we first came out in 2020, I built this software as an Excel sheet for myself and my team selfishly so that I could make better decisions with stocks, real estate, and all these investments in my future. But as we've grown and people said we wanted the software, we made it for others. And now it's about becoming less about me and more about how I can better serve everyone else out there. And this is exactly why we are updating the software. Now, the good news is these changes haven't been made yet. So if you click on the link in the description below to join the software, and if you get the waiting list, or if you actually get in the software, you'll be grandfathered in for life to get everything that's here. All of these tools that are available right here. Boom, and the community. That'll be available. But this is not going to happen forever. There's still time for you to sign up to get everything, but it's going to go away at some point here in the future. So again, click the link in the description below, get access to everything we have to offer. You'll get it for life. And I guarantee you, it'll be the best decision you've made all year because it allows you to sit there, get the community, get people around you that are like-minded. Because guys, I know it. The biggest complaint we get from people is, Paul, there's only 1 or 2 people I can talk to about investing if they're lucky. Most of the time, nobody has anybody to talk to about investing. Now you have thousands of people. You have all these tools. You will absolutely make better decisions as long as you follow a process that makes sense to you. And we're here to teach our process. Take from it what you want. But look at NVR. Look at this. This is an incredible company that we talk about all the time that just bought back shares intelligently. Isn't this the poster child for buybacks?
It's the epitome of a case study.
Absolutely.
Every book that you read, every article that you read, it always goes back to NVR.
About buybacks, which is called cannibalizing yourself because they're eating themselves up. They're basically buying back their shares. And what's so important about that, if you're new, is before I go to the third company here, I want to explain. If there's 10 shares outstanding and you own one, you own 10% of the business. If the company takes the cash flow and buys back half the shares, goes from 10 to 5, you now own 20% of the business. Therefore, your earnings per share has automatically doubled, even if they keep earnings the same. The revenue per share has doubled. You're getting a bigger and bigger piece of the company. But the key is management has to buy back shares at the right price. It can't be at any price. And that's what we see happening these days, Mo. So it takes us to our third company, Dilards. And the reason this is interesting, guys, it's a retail, just like Dick's, but look at this cannibalism of their shares. Let's go to the income statement. 10 years ago, they had 43 million shares outstanding, 39, 34, 30, 27, 25, 23, 20, 17, 16, and they're on a roll. Mo, can you find out what their buyback plans are for the future and their same-store sales growth?
Sure. I'd also like to point out in 2005, they had 83.5 million shares outstanding.
So they're down 80% on shares outstanding. And guys, here's the best part. Revenue, 6.8, 6.8, 6.4, 6.4, 6.5, 6.3, 4.4 for COVID, 6.6, 7, 6.7 in the last 12 months, 6.8. Zero growth. Zero growth. But they're becoming a more efficient company. Look at their profit. 330, 270, 170, 220, 170, 111, loss of 70, 860, 890, 738, and 720. If they can keep that profit grow at the same level, let's go see how their free cash flow is. Yep, big jump in free cash flow, just like that. This is what makes it amazing. If they can keep taking their cash flow and buying back shares, as long as they can maintain the business, that's a big key here. Now, if it's a bad business, you have to wonder yourself, okay, what's going to go on here? Because at least Dick's had seen some growth in revenue. What's Dilards doing right now?
So I want to go over share repurchase first.
Okay, do that.
So they have a repurchase program of $500 million of Class A shares. That's through, that was for last year, because we're looking at the 10K, obviously.
Yep.
So same store sales decreased 4%. Yeah.
That's bad. That is bad. But remember, guys, a declining business, if repurchasing shares at the right price, can still be a good investment. This business is selling for less than 10 times free cash flow. That's big key here. Let me show you a little bit further. All right, guys, so check this out. This is a share repurchase. $6.92 billion market cap, 16.23 million shares, $700 million free cash flow, and I'm assuming it declines 2% per year. So this is a declining business. Stable free cash flow multiple, call it 12. 426 is the price, 9.9 times is current free cash flow multiple. That means to get to this point over 15 years, that's to increase by 0.14 a year. Guys, the market cap will actually decline 0.7% per year, but the price can go up 10% per year. From $48, from $480, $426 a share to $1,600 per share. That's how cannibalizing works. Yeah. Now, let's say the stock fell in half. Let's say the price was $230. Look at that. 15.8% appreciation. That's what matters here. If you buy back shares at the right price, at the right valuation, you are adding shareholder value. If they're able to figure out a way to grow the company, growth rate of 3% and a stable free cash flow multiple of 15, look at this. Market cap increases 6% per year, but the price appreciates 16.7. Let's say they figure out how to just keep it stable. 12.5% increase per year in the price versus 1.3% market cap appreciation. That is the power of buying back shares.
At the right price.
At the right price. So let's go back and look at the 8 pillars on Dilards. Guys, 30% of they bought back more shares than NVR. NVR was 13%. 10 times free cash flow, 13 times earnings, increase of revenue by 1.17 billion. Net income went up for 846 because of that, 610 on free cash flow. Low debt for retail, 1.38 times.
It's interesting that they pay a dividend.
Do they pay? Oh, yeah, they do pay a dividend.
Why do they do that?
That's a wait. Guys.
With as good as they are? I mean,
F this.
Why?
F this.
They're paying out their free cash flow.
F this. What a waste of time. Look at this return on invested capital, 20 and 26%. Now, look at the analyst estimates. Look at these massive drops in EPS, Mo. Guys, go understand why the 4 analysts here are saying that. Yeah. That's important to do before you buy a company like this. For me, I think I'm out on this one. I just don't like, I don't like the fact that revenue has been the same, profits skyrocketed, and then now it's potentially going back down. To me, a better option for retail is probably Dick's Sporting Goods, but it's got to be at the right price for me.
Paul just said, go do some research and figure that out. I bet you that you could probably contact somebody in management at this kind of business.
Yes, you probably could.
You can get some answers.
So guys, if you're in our community, you want to talk to somebody about this, Wicked Willie, who's Dalton, our in-house analyst, great person to contact. Tag him in the general chat, have this conversation. And guys, watch our next video on my process for buying stocks. Thank you for your time.